What's up, everyone? In this video, we're going to be going over some key signs that show you or give you some good insight as to when the bottom is coming for the stock market. And the reason that this video is so important is because the stock market has its way of playing with everyone's emotions, right? So sometimes when it could seem like, it's just a horrible time to be in the market or be investing, those times tend to be the best times. So we have some really cool things to talk about in today's video. Stick with us. We're going to have some fun and we're going to get right to the point. So, Hunter, what are your thoughts? Fill us in. Talk to us.
Yeah, so obviously nobody can perfectly time the bottom, and if they do, it was on accident. But there are some things that happen at basically every top or every bottom. And for the bottoms, every time there's misery, and anytime anybody brings up like investing in stocks, I invest in stocks, and everybody's like, this is the worst thing you could be doing, that's usually the time it's the best thing you could be doing. You'll see on the news everybody giving up on their favorite companies, and when people are saying Google and these companies suck and stuff like that, that's when you're going to have the best opportunity, because everything's going to be beat down so bad due to just misery and turmoil in the markets, and everybody's just giving up because they don't want to see it go to zero, even though the chances are so close to zero that they go to zero. It just creates the best opportunity, and that's usually around where the bottom is.
Yeah, so the market loves, more than anything else, to mess with emotions, and it seems like always that the crowd ends up losing. You know what I mean? So it's like when you see everyone talking about, I invest in stocks, the market's booming, things are great, market just hit the new all-time high, blah, 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 blah. Those times tend to be, for the most part, the not ideal times to invest, to say it politely. Just like you said, Hunter, when you switch roles, when everyone is like, dang, investing sucks, sell everything, the world is horrible, sell it all, right? We're in bad times right now. Those tend to be the amazing times. So it's always keep in mind what the current sentiment is for the crowd. And just you can easily tell by looking at the news. When you look at some of these analysts, a lot of them, they don't have the best track records. You know what I mean? So it's it's kind of easy. It's easy to gauge just by looking at the news and just looking around you. It can actually give you some really good insight.
Yeah, I think yesterday or 2 days ago I saw I think it might have been Morgan Stanley. They gave Micron and Applied Materials a price target of exactly what it was at. What? That's
what?
Why even publish that? That's so stupid. That's saying, here's my price target. Oh, look, it's there. Give me a break. So they really they don't have a better idea of what's going on than the normal person. They really don't. If they did, they would be beating the market, and none of these people beat the market. Not none, but probably 90% of mutual funds and stuff do not beat the market on a year-to-year basis. So people think they're going to experts. You're not. They might be experts, but they're really not. They're just like us.
Speaking of the analyst price targets, Hunter, I don't know if it was with Activision or with Twitter, but how they're both set to be bought out, or at least Twitter was. One of these analysts literally put their price target at the buyout price. I'm like, well, thanks for telling us after. It's too late now, you know what I mean? So it's just it goes to show you, just...
We're all in the same boat.
Yeah, so keep that in mind. But, tell us more.
Yeah, I wanted to say something. So, people should be... It's weird. When the market's tanking, nobody wants to buy stocks, right? They're the same exact companies that everybody wanted to buy last year when they were 80% higher than they are today. That doesn't make sense. That does not make sense that 1 year ago, everybody wanted to buy this company, say it was AMD at 140, when I was telling everybody it was worth 50, mind you. I remember this very clearly. And I was being called stupid. Oh, you're stupid. But now it's getting towards 50. I like it. And people are saying, oh, this is a terrible investment. But a year ago, it was 140 and it was a terrific investment. So it just doesn't make sense. It's if you went to a restaurant, right? And they had a steak. You want this juicy, delicious steak. It's very nice. And it's $100. You wouldn't probably buy it. But if it was 50, looks a lot better. Yeah. But for some reason, it's the opposite with investing. That just, it doesn't make sense to me. And I think it was Warren Buffett said, it's like, stocks are the only time people run out of the store when everything's on sale. And it's true. There's just something about it. And I think I know it's probably because they see their money going down, but and it's scary. But that's the best time. If you liked the company last year at 100 and today it's at 50, and all that's changed is the sentiment about the economy and maybe their revenue forecast dropped like a couple percent, way better. It's way better because, economies have cycles, just like the market, obviously, because they're basically tied. Why not get at the bottom or near the bottom of a cycle? That's the best time instead of the top, which was the last time. And it's, there are no IPOs. The last IPO I heard of was Porsche. Right. And it was in Germany. It was in Frankfurt. It wasn't even in the U.S.
Yeah, that's true. All right, so Hunter, if I'm going to ask you a question and I want you to answer it in like 1 or 2 sentences, okay? What is the best way someone can know when the market will bottom? How would you answer that in like 1 to 2 sentences? And that's a tough question. I'll say that. But I'm putting you on the spot.
Bankers are getting fired or jumping off of roofs, which is not a joke because it happens. It's very sad. And retail traders, people on CNBC and other gurus, their favorite stocks they've given up on. Yeah. And that doesn't mean meme stocks. It could be Apple. When you give up on Apple, Google, those things.
Yeah. Now, I agree with you. I will say one, not even an exception, just something important to keep in mind, because I see this a lot, and I don't entirely blame people for this, but it's a mistake that I see a lot of people make, is people, when they hear the word recession or they hear the word market crash, they think of 2008 or 2009. They think of the dot-com crash. They might think of, the Great Depression or something like a really nasty crash. But there have been many recessions and many stock market crashes that were not as significant as those main ones. So everyone will always look back to those main ones and say, oh, the stock market dropped 30% in a month or two. This is what's going to happen this time. But every single crash and recession is unique. And I feel like especially with this specific recession/crash, it is much, much different than, let's say, the 2008 or 2009 crash. So keep in mind that, everything's different, and I can see this crash and recession not necessarily being like a giant, nasty, panic selling event like the Great Depression or like 2008 or 2009, but more so an extended period of stagnation. Lower returns, nothingness. I
say this every time, I think that's worse. I always think it's worse to have a dead market than a crash, because there's no return in a dead market. Yeah. And you can buy things and get above average returns in a crash. Which is another thing. I would prefer a slow crash, not a whipsaw, because slow one, you have more time to accumulate. You have more time to do research on companies, see what's going on. Things develop over time. So I always think it's better to have, obviously, a slow crash than an immediate one. But I also think it's better to have a crash than a stagnant market.
Yeah, I mean, there's definitely pros and cons to both styles of crashes. When you have all that panic selling, like kind of like what you said, like if the crash happens in like a month or two, or like let's say like 5 months or 6 months or whatever, you have a lower window of opportunity to enter your positions. You know what I mean? You don't have that opportunity to truly load up or get the max position that you want. And at the same time, if you do have margin, margin calls are very, very common in those situations. And it's like a giant snowball effect. It's like, when the margin calls start, it makes stocks go lower, which triggers more margin calls. And before you know it, the stock market has those limit downs like we saw during COVID. So, so like there's pros and cons to it. But then again, with the slow markets, like you have all the time in the world to accumulate, and then 5 or 10 years down the line, you're looking pretty good, and at the same time during the slow markets, you can sell a bunch of premium, whether it's covered calls or short puts, and you'll make bank.
Yeah, the issue with like a stagnant market, I think, is that it's just it's harder to know, because obviously a lot of companies are still overvalued, and if we're in a recession, and it's just going to be harder to buy companies and sell premium on if they just stay flat at an overvalue, especially during a recession when fundamentals get worse. It should just give you lower valuations in turn. I don't know, but another thing is like a fast crash usually, at least it should, give you lower stock prices than a drawn out one, just because of the margin calls and the panic. If there's more panic, you're just going to get more depressed valuations, which does give you better opportunity. It's just a shorter time to capitalize on it. It's like when you saw the COVID crash, it's like a straight line down and just a straight like linear line up, and it just doesn't make sense that companies aren't at their pre-pandemic revenue or profit, and they're trading at double the time, like double the valuation. It makes no sense. It shouldn't make sense. And if it was overvalued during COVID and now the fundamentals are worse and it's twice the price, it's overvalued.
Yeah. I mean, what's interesting is actually a good amount of stocks are actually trading below their pre-COVID levels now, So that's interesting. What I wonder is, like, I know that the government, like the Federal Reserve, does a lot of, like, kicking the can down the road, right? So it's like, all right, we'll be happy now, but in 5 to 10 years from now, we're going to have some problems. Kind of similar to what happened with the money printing in 2020 and the inflation problem, right? What I wonder is, in the event of, like, let's say like a nasty stock market crash, like a quick one, right? Where it's just like COVID style, like straight down, straight up. I wonder if the government steps in that situation and says, you know what, we're going to print money again, we're going to pump the market again, we're going to do whatever we can to, stop this, right? And I wonder if that would, like, if they do act, we know for almost 100% certainty that will just kick the can down the road. You know what I mean? I mean, we were talking the other day with, like, the Bank of England starting to pump their markets again. You know what I mean? And, like, so
they did that exact thing. They went to issue bonds. I believe they went to issue bonds, like $65 billion worth or something. Investors wanted higher interest rates because, they're backed by the government, and people are like, I don't really have that much faith in the government. And it just, pension funds were, one of the bankers said that if they didn't step in, about 90% of pension funds would have went to zero or something. And then the government was doing this to slow inflation. And then they just had to add more liquidity to the market, just doing the opposite of what the goal was.
Yeah.
Oh boy, is it's hard to screw up that bad.
Yeah. So it's like that's why I really don't want, like, a quick crash. You know what I mean? Like, I know
I don't want a quick one.
Oh, I thought you said you did. Sorry.
No, I want a slow, drawn out one.
Okay, yeah. Okay.
Yeah.
We're on the same page then.
I want a slow, drawn out, but I want it to go down. I don't want it to stay stagnant. I want it slow, because I think it'll cause less families to panic sell their retirements.
Right, that's true.
I think that it'll give them more time It definitely will. It's not. I think if it is that way, their 401ks, their contributions and stuff, and their matches they'll be accumulating more and more cheaper, and it will be better for them. The people it will be worse for are the ones on the brink of retirement.
Right.
But a lot of those people had switched to more fixed income.
Right.
Before that, at least they should have. So it's, someone's always going to lose, but there is always it's like a lesser of all the evils. Mm-hmm. And I think that's probably the best way for the vast majority of people.
Yeah.
In the long run.
Yeah, I agree. I agree for sure. And I feel like the most realistic outcome is I think we are going to see just a slower move. You know what I mean? Like, I feel like most of the move has already happened to the downside. You might disagree with that. And when I say that, that does not mean it's the bottom. I'm not trying to call the bottom here. What I'm saying is most of the downside has already happened, in my opinion. So, I feel like over the next couple of years, we're just going to see, just stagnation. You know what I mean? For multiple reasons. I think the consumer is a lot stronger now than it was in previous recessions. And I believe, and I really hope I'm right on this one, is that inflation has peaked. I think that's a key thing to look at, just looking at the whole economy. Because if inflation hasn't peaked and it's not showing signs of slowing down, then we're really in for trouble.
Mm-hmm. So, yeah, it's going to be bad. We'll probably find out in the months following the midterms. That's probably when, because, with the strategic oil reserves and stuff, I'm not going to really get into it, but the gas prices were down a lot, and inflation still came in hot. And that was especially core inflation, which strips that out. So we'll see after the midterms. I'm hoping that it's not going to go higher because I have to pay for things, and so does everybody else. And but we'll see. And I mean, I have a comment in the Discord from 2021 or the end of 2020 when I was saying, if you guys thought 2020 was bad, the debt train hasn't come yet. I'll try to find it. Here we are.
Yeah.
You can't just mint money nonstop and shut the world economy down and then just think there's no consequences. That's not how it works. Especially you shut down the world economy and now the market doubles.
Yeah.
That's just not how it works. Things don't go parabolic and just, especially on worse fundamentals, and just sit there or not. Things get bad. Get bad. There's always a correction.
True. All right, well, I hope you guys enjoyed today's episode. It was a little bit longer than normal, but I felt like it was pretty good. If you guys want us to talk about any other specific topics, let us know in the comments down below. Hunter, before we close out, do you have any final thoughts or anything you want to say?
No, I guess maybe if you are if you're in it and you see the market keep going down and down, and you have good companies, or maybe you're holding just S&P 500 ETFs, stuff like that, don't get rid of them. It's just better to stay in and average in over time. Even Warren Buffett says that. So,
yeah. All right, there we go. Well, thank you guys so much for watching. If you liked the video, make sure to subscribe. Besides that, don't forget to subscribe and let us know any comments down below. Besides that, have an amazing weekend.